Welcome back to the Deep Dive. So you sent over a really fascinating stack of material this week. We've got white papers, some notes on a proprietary trading philosophy, all from Carlos Martins at Translate Stocks.
Yes, and I think we need to be clear right up front.
Okay.
Our mission today isn't to review some, trading robot. It's to evaluate what they call complete survival architecture for trading.
Right. It's a whole philosophy, and it's built on this one, I think, brutal truth.
hmm
Most traders fail. And not because their strategy was bad, but because they just couldn't psychologically or, financially survive the journey. The ups and downs, the drawdown.
Or do they blow up?
Yeah.
Simple as that. The variance just grinds them down.
Exactly. So this philosophy tries to solve that very human problem with three interlocking pillars, and they're borrowed from totally different fields.
Right. You've got the math, which they call futures mining theory.
Then the behavioral side, Pascal's wager market theory,
Yeah.
or PWMT.
And finally, the engineering foundation, the reserve capacity market theory, or RCMT.
Okay, let's unpack this. I think we have to start where they do, with the non-negotiable part. The math. The math of just staying alive.
Well, when you look at the source material, the core idea is that human emotion is always the weakest link. It just is.
So you have to automate it away.
You have to. The system has to be automated, and its number one job, its only priority, really, is survival. They call it the survival-first approach.
And they have this goal of, what do they call it, a laminar equity curve?
Yes. Laminar.
Why lean on physics analogies like that? What does laminar flow tell you about trading that, say, the Sharpe ratio doesn't?
It gives you a visual, a tangible goal for your risk management. In fluid dynamics, laminar flow is smooth, it's streamlined, no turbulence.
Right.
The sources literally introduce a laminar portfolio equation. They even talk about the Reynolds number of a portfolio.
Wow.
The Sharpe ratio tells you the end result, the risk-adjusted return.
Yeah.
But this Reynolds number idea, it tells you about the process. It's designed to flag the moment your account starts getting turbulent and chaotic.
So you want your account to look like a gently rising river, not a roller coaster.
That's the perfect way to put it. And the main way they enforce that flow is by banning the most common, and I'd say most dangerous retail trader habit.
Martingale sizing.
Exactly. The white paper spends so much time just taking apart martingale, the idea that you double down after every loss to win it all back in one shot.
We've all been tempted by that, right? At a casino or something. It feels so intuitive.
It feels intuitive, but mathematically it's a guaranteed disaster. Given enough time, it will lead to ruin. It's not a question of if, it's a question of when.
It's the ultimate psychological trap. It promises to erase the pain of the last loss.
But it does that by exposing you to just exponentially higher risk. So Translate Stocks throws that out completely. Instead, they use linear sizing.
Which is just a fixed, very small risk on every single trade.
Right. Regardless of what happened on the last one. It's boring, I'll give you that, but it's the only way to mathematically guarantee survival against that variance.
And how do they make sure the user actually sticks with it?
The system constantly calculates this metric they call distance to ruin, DR for short.
So what is that, basically?
Conceptually, it's asking, okay, with our current position size and volatility, how many losses in a row would it take to wipe us out?
That's fascinating. It's like a real-time safety score.
It is. And if that DR score gets too low, if the risk of blowing up gets too close for comfort, the system just stops. It halts all trading.
The priority shifts from making money to just not losing it.
Instantly. It's all about protecting the principal and getting that DR score back up. It's, pure quant finance, but it's packaged in this brilliant way to force a survival-first mindset.
Okay, so the math is the foundation that keeps the boat from sinking. But what stops the human pilot from panicking and just jumping overboard during a storm? This is where I thought it got really interesting. How do they handle our built-in emotional flaws?
That brings us to pillar number 2, the behavioral one. Pascal's wager market theory, or PWMT.
Based on the philosopher's wager.
Exactly. The idea is, since we can never truly know the future, the best strategy is simply the one that maximizes your chances of staying in the game forever.
Okay. And how does that apply to trading?
It means they push for high-frequency, small-gain trading. So instead of trying to hit one massive home run once a week, the system might execute 100 tiny trades a day.
Because the statistics are better. More trades means you get closer to your expected outcome faster. Luck gets smoothed out.
You got it. It reduces the variance, the luck factor, much, much faster than taking one big concentrated bet.
And that has a huge psychological benefit. If you take 100 trades and the first 10 are small losers, It doesn't trigger that panic, that loss aversion that makes people do stupid things.
Precisely. The whole goal is to smooth out the drawdown curve so you never hit your own personal psychological stop
I
loss.
like that term.
If you see a nice, gentle upward grind, you're just not going to panic and interfere. But if you see a terrifying vertical drop, even if the total loss is the same, you're going to break your rules. The path you take matters just as much as where you end up.
And that idea of path dependence, that leads right into their controversial view on costs, right? Because high-frequency trading means huge commissions.
It does. And the sources reframe this completely. They argue you shouldn't see those as fees. You should see them as insurance premiums.
Insurance for what?
You're paying that premium to buy a smoother, less volatile equity curve. You're basically accepting a slightly lower total profit in exchange for a much higher Sharpe ratio, a much more stable ride.
It's a trade-off, a calculated one.
A very calculated one. If your gross edge is big enough to begin with, paying for a survivable path is, well, it's a perfectly valid choice.
That makes a lot of sense. Okay, let's move to the third pillar, the one from engineering. Reserve Capacity Market Theory, RCMT. This one felt the most counterintuitive to me. It's about being inefficient on purpose.
It's so important to understand why. RCMT uses the analogy of, say, a power grid or a Formula One engine.
Okay.
If that system runs at 100% capacity, yes, it's super efficient, but it's also incredibly fragile. One tiny thing goes wrong, the temperature spikes, and the whole system just crashes.
So a robust trading system needs slack.
It needs slack. It must be inefficient on purpose. That means you keep capital in reserve, you don't bet everything, and, this is critical, you avoid over-optimizing for the perfect entry or exit.
Because that leads to overfitting.
The number one killer of algorithmic strategies. They look amazing in a backtest on historical data, but the moment the live market behaves just a little bit differently, they break catastrophically.
So RCMT is about building in resilience, building a system that can bend when the market throws a curveball, because you know it will.
Exactly. It's admitting that markets are chaotic,
Yeah.
so you have to design for that chaos from the ground up.
All right, now we have to apply some critical thinking here. The sources are pretty upfront about the challenges. Let's talk about the weaknesses, starting with the one we just touched on, high transaction costs.
Yeah, this is a real risk. If your whole system depends on high-frequency, tiny profit trades, your growth edge, your edge before costs, has to be very, very high.
And if that edge shrinks,
If volatility drops or spreads get wider, suddenly those insurance premiums we talked about are eating your entire profit.
a winning system can become a net loser just because of costs.
That's a huge structural risk. So what's the reconciliation for that?
They just double down on the justification. The system is designed to prioritize the path, not the destination. It's aiming for the highest Sharpe ratio, the smoothest, safest ride possible, even if that leaves some profit on the table.
So it's a philosophical choice.
It's a choice. You trade a bit of return for reliability. And that works if your gross edge is strong enough to survive different market cycles. Okay, the second big hurdle, and this is for any user, is the complexity and black box risk. The core AI, this model they call TGT4, it's proprietary. You have to just trust that its predictions for drift and volatility are correct. That's a big leap of faith.
It is a huge leap, but this is where the system's evolution really provides a strong counter-argument. The sources explain how it moved from a pure black box to what they now call a gray box or a co-pilot model.
What's the difference? Help us define that.
So the AI's signal, why it thinks the market will drift up over the next 5 bars, that part is still a black box. It's their secret sauce.
Right.
But the trade management logic,
Yeah.
how positions are sized, how linear sizing is applied, when to add or reduce, all of that is completely transparent. It's all laid out in their price on rails methodology.
So you don't know why the AI wants to buy, but you know exactly how it will manage the risk once you're in the trade.
Precisely. And that transparency about the execution rules, it builds the trust you need. It gets rid of that fear of, why did this system just double my size?
Yeah.
And that brings us to, I think, the most important metaphor in all the source material,
The Iron Man suit.
the Iron Man suit.
This is probably the most critical takeaway for you, the listener. You really shouldn't see this thing as an autonomous robot. It's an augmentation layer. The human is still the pilot.
Yes. The human provides the high-level judgment, the timing,
And the AI handles the physics. It does the constant microcalculations, the stabilization. It manages all the boring math so the human doesn't have to.
And that framework is what enables the real genius of the system. It's a behavioral hack. It's the gamification of discipline.
Explain that.
A normal trading platform gives you a dopamine hit from your P&L.
Right.
How much money did I make today?
Sure.
This system changes the game entirely. The user interface visualizes the laminarity, the smoothness, and most importantly, your distance to ruin score.
Ah, so the goalpost moves. It's not, did I make money? It's, is my DR score high? Is my path smooth? Am I surviving?
It shifts your entire reward system. It forces you, the user, to respect the mathematical rules from the futures mining theory without you ever having to do the complex math yourself. It automates the painful part, the discipline that most traders just can't maintain.
And there's one more thing we should mention, a huge green flag for legitimacy that was in the sources.
Institutional grade reliability.
The system integrates with major regulated brokers, NinjaTrader, TradeStation. Why is that so important?
Because it means Translate Stocks is just a software company. They never hold your money. They just send instructions to your broker.
It completely eliminates the risk of a Ponzi scheme.
Absolutely. It proves legitimacy through that separation of duties.
So if we look at this whole architecture, it's clearly not snake oil. It's a serious high-end engineering solution for a very specific problem. Retail trader ruin caused by emotion. It's a force multiplier for discipline and consistency, not a get-rich-quick machine.
I think the target user is what you could call the engineer trader. Someone who gets the math, they understand why they need discipline sizing. Maybe they even have a real edge, but they just can't execute it without emotion, day in and day out.
So it automates the boring, painful, but absolutely necessary math. It automates discipline.